The Federal Reserve has decided how to combat inflation. As anticipated, they raised short-term interest rates a quarter point today. First time they've raised rates since 2018. It's all in an effort to slow down the worst inflation in this country since the early 1980s. Tonight, our Iran Hami tells us what effect it's going to have on our wallets.
High interest rates are going to hurt Corpus Christi a lot more so than the rest of the country because our economy is still very fragile.
The Federal Open Market Committee announced they raised short-term interest rates to 0.25%, and we can expect 6 more interest rate increases this year. Economics professor Jim Lee says that rate primarily applies to banks and how they borrow, but it will in turn force mortgage rates, auto loans, and credit card interest to rise for long-term borrowing.
The Fed's intention to raise interest rate is to calm down inflation. And we are talking about runaway inflation that we are seeing right now. Everything jumping at the highest rates that we've ever seen, at least in this generation.
Lee says money needs to be taken out of circulation. He says there is another way to combat inflation, and that is to increase supply. Still rebounding from the pandemic, the country continues to face supply shortages, and you have to throw in the unpredictable of what is happening in Ukraine. And there's the unintended possibility of higher unemployment, which Lee says Corpus Christi is more susceptible to.
I know this is hard for everybody right now because, we're still talking about 6.6% unemployment in Corpus Christi. So that'll be something that we should be concerned about.
The Federal Reserve says they want to bring that inflation rate down to 2%. Lee says that's a process that will likely take a few years. Reporting in Corpus Christi, Ron Hami, Action 10 News.